All right. Welcome to today's webcast. I'm with JT Capital, a boutique private equity firm with a strategic focus on acquiring and managing multifamily apartments. Our expertise lies in optimizing operational efficiencies and value-add opportunities. We are committed to fostering sustainable growth and maximizing investor returns through meticulous asset management. Today, we delve into the challenging insurance landscape as its influence on investment pricing, and it's a pertinent discussion as we also launch our new strategic income fund, which considers such variables in its approach. I want to welcome Zach, who's here alongside with Pooja Talati, who's also a co-founder of JT Capital. Zach is a distinguished expert in multifamily insurance sector. He brings a decade of specialized experience in today's discussion. His dedication has cultivated a vast clientele with over 90% of his business portfolio consisting of apartment complexes across the nation, with significant presence in Florida, Texas, Nevada, Arizona, and the West Coast. He manages over $40 million in annual premiums, which places him as the second largest book holder within his firm over at Wrights Insurance, demonstrating not only his expertise, but also his trusted reputation within the industry. Join me in welcoming Zach, who's not just an insurance specialist, but also a true advocate for his clients. With that, Pooja, I'll let you take over.
Sure. Well, Zach, thank you for being here. Really appreciate it. I'll just dive right in, but we've worked together for many years now. And I know at the beginning we would have very small single-digit renewal rates. And so I guess I'll set the expectations, as the years have progressed, insurance has gone up as you expect, but I'd say 2023, the rates just increased significantly. Can you kind of help us understand why that happened, why the sudden change in the landscape?
Yeah. So it's kind of twofold. I mean, when you talk about insurance costs going up, the way that most of that cost is going up on the property side, the liability side has gotten worse as well. But I'd say like on the liability side, for instance, like on an asset in Florida back in 2018, you could probably insure that for say $60 a unit for general liability. And now in 2023, that pricing is probably, depending on the program, it might have doubled in the last 5 years, which isn't terrible for like a five-year period. On the property side, like the property insurance could have doubled 2 or 3 times over in that same span. And there's a couple different reasons why. I mean, with inflation has really affected obviously replacement cost and what it actually costs in the event that a building burns to the ground or that a roof is destroyed in a hurricane, whatever it may be. The cost to replace that structure is significantly more than it used to be. And so for a lot of years, while we were in a soft market, insurance companies sort of looked the other way on valuation of properties. In other words, dollars per square foot. So back in like 2018, even 2019, you could insure something like, again, using Florida as an example, a lot of times we used sort of like $75 per square foot as sort of a barometer for valuation. Well, that's kind of carriers, once Irma hit and Hurricane Harvey and Hurricane Irma hit in 2017, one in Houston, one in Florida. And after and then the ramifications of those 2 storms were felt for about 3 years, because back then the statute of limitations for filing a hurricane claim were 3 years. And so a lot, there wasn't a lot of immediate correction to the market in 2018 or 2019 and even 2020, because claims were continuing to be filed in those years. It wasn't really till 2021 where carriers started to have a real idea of how much they had paid out due to those storms. And then they started to look at what the actual reconstruction cost was and how low they were. And so we've gone from, I would say like in 2020, you could still be at maybe $75 a square foot, to then it got bumped to like 90 and then 100. And now we're at like kind of, sticking with like Florida as an example, now your baseline is pretty much like 130. So you look at like a 3-year period, your valuations have gone from like $75 a square foot up to 130. So that's a pretty large percentage jump. So you have that, which drives up your total insured value. And then on top of that, you have just rate increases. And so those rate increases are obviously a result of, I would say, like, to answer your question just really simply, I'd say it's been weather events. and it hasn't just been necessarily like named storms. I mean, it's been obviously wildfires have been on the rise the last several years. Obviously, what happened in Hawaii this year was like the worst example of that. But those every insurance, to sort of explain it, every insurance company also has their own insurance called reinsurance. And a lot of those reinsurance companies might insure, they might insure a company that does business in Florida. They might insure a company that does business in California, Hawaii, Montana. So those reinsurance companies are absorbing a lot of the losses around the country, even if the actual insurance companies aren't the same. A lot of the reinsurance companies, like a Lloyd's of London, Munich
Mhm.
Re, across the pond in the UK or Germany, they're absorbing those losses. And so that's where all those weather events, whether it's a wildfire in California, or a tornado in Tennessee, or a hail event in DFW, or obviously hurricanes, in Houston and throughout Florida and whatnot. Those weather events is really what's driven, the rise in insurance. And unfortunately, like even if you have a clean loss history, it may not, like it's always going to be to your benefit to have clean loss history, but everyone's kind of been lumped into getting these significant increases, because the bottom line is, like, insurance companies, obviously it's a larger scale, but they're running a business just like everyone is, and they're looking at their books saying, we have lost money in Florida, or we've lost money in Houston, and we have to increase our rates significantly in order to get profitable. And so it's the last 2 to 3 years has been that process. It's a painful process of trying to find that market equilibrium where they are going to be profitable again. And I think, in Pooja, we might get into this more as
Mhm.
we continue to discuss, but I think we're probably starting to find it. Like 2022 was a rough year. And depending on a few different factors, 2022 might have been rougher for some than 2023, but 2022 and 2023 were pretty rough. And I think, we're essentially out of hurricane season now. I mean, technically there's 28 days left, but typically no significant hurricane has ever hit in November. So we should be kind of through the woods without a major storm in 2023, which is a win. So I think my prediction, cautious prediction for 2024 would be something that's a little bit more palatable than what we've seen the last couple of years. I would not estimate that things are going to be flat by any stretch, but I think, could we sort of go back to 20 to 30% instead of 100%, instead of 50%? Like that's sort of what I would expect to see in 2024.
And do you expect this is the new norm in terms of square foot pricing? Like we'll never see it go in the other direction?
Yeah, probably not, just because like historically prices always go up. So it's, I mean, it's a lot of it's tied to, lumber prices and just the cost to rebuild. So like in Washington State where I live, I mean, you're at like minimum 200 a foot. I mean, you're like 200 to, depending on the, if it's like a brand new Class A complex in Renton, Washington, I mean, it could be close to 300 a foot for replacement cost. So I don't really see that going down. Yeah, it's unfortunate. Unfortunately, it's just sort of the new baseline. But what I can see, to be on the positive side of things, is that insurance companies, even with like bumping values up to, 125 or 130 or 150, whatever the number is, they still across the board for the most part are relatively low, which is two-pronged. It works to your advantage from a pricing standpoint, because like I had a claim last year or this year in 2023 of a total loss in Florida, and the reconstruction cost of that building was more than 125 a foot. I mean, it was like 175 a foot. So you're still getting like, I hate to say free coverage, but like kind of,
Right.
I mean, they're still underpricing it. Where you have to be careful is blanket coverage has pretty much gone away. Like, again, using Florida for an example, for the most part, it's pretty rare to get blanket coverage anymore. So you don't just want to look at what either A, your lender's requiring, or B, your insurance company's requiring. You really want to look at, like, what is this actually going to cost me to replace in the event of a total loss? because if you don't have blanket coverage, meaning that if you have like 10 buildings, like let's use round numbers. Let's say you have 10 buildings and your building limit is $10 million. So you have $1 million per building, and that breaks down to 125 bucks a foot. Well, if you lose one of those buildings, and instead of it costing 125 bucks a foot, it costs 150 bucks a foot to replace, you could be potentially underinsured by, $250,000. So you do have to be careful to make sure that you are insured at a level you feel comfortable with, and you're not significantly underinsuring your assets.
Yeah, no, that definitely makes sense. In terms of the future of insurance, do you see any like legislation happening? I'll give like Florida an example because that's where a good portion of our properties are. Do you see any of that helping out? I know insurance has gone up probably across the United States.
Yeah, I do. I think there's already been some legislation passed that I don't know the exact specifics of it, but for instance, if you have a open claim from like Hurricane Ian last year in 2022, if you have an open claim and there's still unrepaired damage at the time of your renewal, the insurance company is required to offer you renewal in some capacity. So that doesn't necessarily mean they're going to offer you a full annual renewal. It might be an extension. And it doesn't necessarily mean they're going to offer you the same terms, but they have to give you some type of renewal option, which is basically it protects you from being on the open market with unrepaired damage, which no insurance company is going to want to insure. So it sort of eliminates the probability or the chance of you being completely uninsured during hurricane season. So that's been one positive. The other positive has been they reduced the statute of limitations, again talking about Florida, from it was I think 3 years to file an insurance claim due to a storm. I think they reduced that down to 1 or 2, and so that's going to help with the amount of sort of fraudulent claims that are filed like 2 or 3 years after the fact. Like for the most part, if you have like if a hurricane hits your building and you need a new roof, you're typically going to know if it's legitimate. You should know within the first like 6 months. I mean, like most of my like ethical clients are reporting things pretty quickly. It's always a little bit shady when it's like 2.5 years after the fact and then they file a claim, and so that's one of the things that's changed. And there's a lot of sort of I call them ambulance chasers out there, where they're roofing companies that'll literally door knock and after a storm and up to 3 years after, and then file claims. And so that's where that's hurting. Like that kind of ultimately ends up hurting the consumer because way more is being paid out by the insurance companies, and then everyone's paying for everyone else's sins. And so I think that those are a couple positive pieces of legislation. I think another thing that could potentially happen, sort of with what we see with FEMA and what they do with the National Flood Insurance Program. For anyone that's not familiar, the NFIP stands for National Flood Insurance Program. That is administered by FEMA. So it's a government-sponsored program, and it provides a certain amount of flood insurance. And so it's since it's government-sponsored, it's essentially subsidized. It's much cheaper to purchase like an NFIP policy than to purchase a private policy through the market. And this is not actually based on any of my own intel. I think insurance is getting so expensive and so unaffordable in some cases, where it wouldn't surprise me if FEMA at some point on some level got involved and offered and rolled out some sort of a program specific to named storms, where, again, maybe if it was structured similar to like an NFIP program on the flood side, it would be like, we're going to offer you $500,000 primary limit per building, and you can then purchase limits on top of that. But it would sort of give you a competitive like primary option to sort of bridge the gap a little bit between your deductible and your insurance. So I wouldn't be shocked to see a program like that rolled out at some point, just because again it's getting so expensive. The other thing is like state-run programs. I don't know if you're familiar with like Citizens Insurance in Florida, is like Florida state-run program. It's really, really picky. It's not necessarily competitive, but I think it's getting a little bit more competitive because the market's in such a mess. I think that those state-run programs might start to be a bit more competitive. And then the other thing I do think is that insurance sort of operates a little bit inversely to the rest of the economy. So in a soft market, in a soft insurance market, a lot of times that's because the general economy, the stock market, the real estate market's going up, up, up. And as we sort of enter an economic downturn a little bit, insurance is more of a safe haven investment. And I think there will be more capital that'll flow into insurance, which could cause some easing of rates on some level. So I think there's some hope there. That's not really legislation, but it's sort of an economic impact potentially.
Awesome. Stefan, do you want to talk a little bit more on some of the acquisition side that you're seeing, and then I can switch back?
Yeah, I think it's interesting, Zach. You know, you and I spoke several months back about this topic where, you know, you have groups that are looking at acquiring deals, and we no longer can get bindable quotes. And so, you know, what are you seeing today in terms of how clients are navigating around that? And then kind of follow up to that, just based on pricing where it's at, we're seeing a lot of deals just retrade late stage into the acquisition process because we get maybe several weeks out from closing, and all of a sudden that pricing doesn't work anymore. So both the seller and buyer are now trying to find new pricing because that price is location there. And so are you seeing anything creative in terms of getting through maybe those scenarios as well, where potentially a group maybe just transferring it over? And so, you know, if you can speak a little bit about both of those.
Yeah, the only real way to avoid the issue you're talking about, which is basically, from understanding the question, right? It's like you can't, generally insurance companies aren't releasing quotes more than like at the most 30 days in advance. And so you're already under contract, but you're under contract without knowing exactly what your insurance costs are going to be. Is that basically the question?
Yeah, that's right. You know, and then
Yeah.
I think we were talking about if there's a storm and all of a sudden, you know, the quote's just blown out.
Yeah. Yeah. So there's really no avoiding that scenario where like the only way to sort of avoid that scenario is if you have a bindable quote on the table and there's a storm on the horizon, you have to almost bind it right then, because if that storm hits and there's any damage, then you're not going to be able to close, because you're not going to be able to get insurance, because they'll pull that quote and re-rate it, or they might just decline the quote altogether. So it can really leave you in a lurch. As far as like creative solutions, I mean, Pooja, I was obviously talking to you about this earlier today. One thing that I'm sort of surprised that we haven't seen more of, I've seen it once so far in the last year, but I'm surprised we haven't seen more of, is companies, the acquiring companies coming in and literally acquiring the entity itself, not just the asset, but the entity, the LLC or the LP, whatever it is, and taking over their insurance policy. Because insurance companies won't transfer insurance policies at this point. It's a dead end. It's a no, has been for a couple of years now. But if the entity doesn't change, we really don't even have to notify the insurance company. I mean, the entity is still the insured entity. And so you can assume the seller's insurance policy, which can be a huge cost savings. And I mean, it's a cost savings and you have coverage. So it sort of eliminates some of the risk. But unfortunately, yeah, with the environment the last couple of years, I mean, it's literally been, you may not have a bindable quote till you're within 7 to 10 days of closing. It's really unfortunate. That's where I think it is important that you're, you know, working with, what we try to do is be as upfront as possible. If we know any of our clients are looking at a deal, or deals in general, is let us know up front what you're looking at in terms of where it is, the location, and we can sort of give you, you know, we're going to give you a really raw, like, worst case scenario, so that you're going into it eyes wide open. Like if you're looking at a deal in Tri-County, you know, you're in like Miami, or you're on the Gulf side, you're in Tampa, or you're in Houston, you know, right on the coast, like, and it's July or it's August, like there's a high likelihood we're not going to have terms till we're within 2 weeks of closing. And we aren't really going to know exactly what insurance is going to cost till we get there. And a lot of that can be determined by the size of the deal too, and capacity. In general, it's going to be easier to do smaller deals. If you got a deal where the total insured value is like north of 50 million, that's a lot more layers we got to build up to. So that's another sort of hurdle as well. But yeah, I think that's where we've tried to just take a real proactive approach to just communicating with our clients, because there is more risk involved, I think, than there ever has been on the new acquisitions. And just to clarify, everything I just said that's more related to coastal. So that's not necessarily related if you're non-coastal. you know, if you're looking at like a deal that's built in 2018 in San Antonio or Austin or, you know, Denver, like we can generally get something more 3 weeks to 30 days in advance and give you a little bit of a better idea what it's going to cost. In the coastal areas during hurricane season, it's such a crapshoot. It's really tough. And I hate to like lead my clients down a road where I may not be to deliver on the number I told them. It's really tough to predict where things shake out. And like you guys have even seen this on some of your deals. It's bizarre. Sometimes for the most part, we're delivering bad news, but there's been a couple times where we've actually gotten really, really good deals, and it's tough to predict where it's going to be, and we just don't know until we get them sometimes. Which is, I hate being vague like that, but it's just a reality of kind of where we're at.
Yep. Do you foresee, like what we talked about earlier today, I guess, with entities kind of being assumed, that the industry may catch on to that and then they'll say, no, you can't do that either?
Yeah, usually there's kind of that like that period of time where they're not wise to it. But that can take a year or two. Like it's similar to like an insurance company in Florida that we've done a lot of business with, auto owners. They've been writing everything for like the last 2 years. And now what do you know? They're not profitable. So now they're starting to like rate increase stuff or not renew it. But it's usually like a 2 year period or 2 year phase where it's like the first year, it's like, oh, here's a 40% increase. And then next year, it's like, next year we're non-renewing anything that has a claim. It doesn't matter if it's a slip and fall that was closed out for $0. It had a claim, we're getting off it. And then the third year, it's like, we're not renewing everything. It's usually like kind of a phased approach. So it's sort of similar, like the only, whether it's lenders or the insurance companies catching on to it, it usually takes them a year or two. So it's, you know, is it like a long-term solution? I mean, probably not. But the one thing I would say in this market is like, you just got to take things a year at a time and sort of take whatever you can get in the moment, because it's just a year-to-year problem to solve. So yeah, is it something that's probably going to be feasible for like years to come? It's doubtful.
Yeah, I mean, that makes sense, because I think if I'm not mistaken, at least in Florida, they passed legislation to get around, or not to get around, but at least put an end to the AOBs, right? Time and the benefits. And I almost see this as a loophole to kind of get right back into it in some way. If I'm not mistaken on that.
Yep.
What, if you can explain to people, because I know, when we're acquiring, there's always so many things that we're looking at, and I've started to see things get taken off the table. Like, and again, I'll use Florida as an example. Used to get quoted at maybe like a 5% wind hail, but then you can buy it down to 2% or 1%. And now some people aren't even offering that. Blanket coverage may not be offered. So what were things in the past that you could get that now either are not available anymore in 2023, or it's really high that you just haven't seen people go down that direction?
Yeah. Good question. I think you pretty much nailed it on the head. I think blanket coverage is a big one. We've seen that pretty much go by the wayside. There's one company, Sigma, that will occasionally still offer it. They're in Florida, but their appetite's pretty restricted. So blanket coverage, I'd say, is again, using Florida as an example, like we still can get blanket coverage depending on the carrier. Like we're working on a deal right now in Austin where we have blanket coverage available. We just did a couple in San Antonio where there was blanket coverage. So it, like, depending on the deal, it is still feasible. But like in Florida, as using Florida as an example, blanket coverage has gone by the wayside. Named storm deductibles, you're not really seeing anything less than 5% anymore. The only exception to that rule that I've seen is on that one asset with you guys that I think we renewed this past summer at a 3%, which was crazy. I still don't know how the underwriter released it, but they did. So that, of course, then we didn't have a claim, so you take advantage of the great deductible.
Yeah, I think we bowed right away on that one.
Yeah, we did. So you're pretty much not seeing anything any lower than 5% on named storm deductibles. On the all other perils deductible, so your deductible for like water damage, fire, that's still relatively competitive. Maybe like 5 years ago, you would have still seen like 10 grand. Now it's up to like 25 grand. In some cases, 50. So, I mean, that's significant. Too. Some carriers have instituted different water damage deductibles due to like freezing events, probably, freezing events in Texas and whatnot. So some carriers have instituted either water damage deductibles that are higher, like 100 grand, or like water damage sublimits of insurance. So the deductible might be the same as your like fire deductible, but the sublimit of insurance, instead of being limited up, the full limit's up to 50 million or whatever your total insured value is, it might only be up to like a million. We've seen that too. That's one company in particular that I work with in Texas that we've seen that on. But yeah, that I would say that's the main one. I will say we've been talking mostly property coverage. On the liability side, we've seen a lot of that. So the big ticket ones that we always look out for are number one, assault and battery. Number two, abuse and molestation. Number three, I would say, is probably animals. So any type of like dog bite, things like that. And then fourth would be like habitability. Habitability kind of refers to like infestation type claims like bed bugs, basically any type of claim where the plaintiff is alleging that there was an uninhabitable condition in their unit, something like that. So, and those claims are way more common out here on the West Coast. But they can be common in Florida too, because there's enough moisture, so that can lead to sort of, mold and whatnot. So those types of exclusions are really what we're looking for on general liability policies. But they're still available, to be clear. Like it's just something you want to be very aware of. Like I believe off the top of my head, I think every policy we have with you guys doesn't have any of those exclusions, but we're very, very vigilant of that. And some brokers aren't, or some clients aren't. And it's something to definitely be aware of, is to really review the forms and endorsements on your general liability policy to make sure if like it could be like a fight that breaks out and I've literally had this claim where a fight breaks out at like the gas station down the road, and some sort of a chase ensues, and someone ends up getting killed on your premises, and you get sued, and now you got like a 6-figure liability claim that may be excluded if you have an assault and battery exclusion. So those are I think we've probably seen more concerning increases on or decreases in coverage on the liability side even than the property side.
No, that's good to know. I think everybody's focusing a lot more on the property side, especially on the underwriting, than general liability, but it looks like we're going to start to see that change from like a landscape perspective as well.
Yeah, I think again, I would say there's probably more concern over the coverage on the liability side than the pricing. I mean, pricing's gone up too, don't get me wrong, but it hasn't been as drastic as property. We've started to see it creeping into more consistently like triple digit per unit territory, where it's like, okay, yeah, we got a clean form, but it's at 130 a unit or whatever. Clean form meaning no A and B exclusions, no animals exclusions, things like that. So the cost is going up, but not like alarming, quite like property. It's just the bigger concern is the coverage side.
Sebin, do you have any other questions, or I have one more?
Yeah, one more, go for it.
Yeah, okay. Well, I just, we talked a little bit about this because we had a lot of emails going back and forth this summer about it, but can you tell us like what's going on with State Farm?
Yeah.
You were able to like underwrite these crazy prices that we just haven't seen.
Yeah, I can speak to that. So we actually used to work a little bit with State Farm, specifically in Texas. Using Florida as an example, State Farm hasn't done anything in Florida that I'm aware of. And I would probably be aware of it because everyone, you follow wherever the market's competitive. So State Farm in Texas had been really, really aggressive. But the thing you have to be careful of with like direct writing companies, like a State Farm, Farmers Insurance, American Family is another one, and like Allstate doesn't really do anything in the multifamily space, but like American Family, State Farm, and Farmers do. And they all have a wording basically in their quotes where all their quotes that people bind are actually like technically estimates. And so after those policies are bound, coverage is in force, it's legit, but then they can sort of audit things or like re-inspect, and then they reserve the right to drastically increase your premium, or they can just like issue a cancellation. And that's obviously, I think the one you're alluding to, Pooja, is what we saw, where they bound coverage on like September 16th, and then literally 30 days later, or maybe not even, they cancel coverage. You know, they issue a 30-day notice, but they cancel coverage, they get off of it. And so State Farm is just really, like, I would say, very unstable, not unstable financially, although they did get downgraded by AM Best. For anyone that's familiar, AM Best is like the largest rating company of insurance companies. So they rate based on like financial size, and they also rate based on like outlook. And so the outlook, the financial outlook for State Farm was downgraded from stable to I don't know if it was negative, but it was or something in between there. So it was downgraded, which is kind of always significant news in the insurance world. When a company is downgraded, it's not a great sign. Basically means they overextended themselves, and which, shocker. I mean, based on what we were seeing them do in specifically in Texas, they were giving away coverage compared to the rest of the marketplace. And it was the type of deal that we would tell our clients, like, look, if you can go to State Farm, we can even sort of facilitate you, because we work with State Farm agents, or we used to. And then State Farm kind of cracked down. They won't work with us anymore, or any independent broker, because they were getting inundated and they were writing everything. And now clearly they've been losing money because now they're not renewing things, they're canceling things. We did a deal with State Farm for one of our clients. They're based out of California, but they had a Class A location in Houston, Texas. And we bound it back on like April 1st. And then they re-inspected or something in like May, and they gave them like a $50,000 increase midterm. Now, it was still so competitive that like the client stayed with them, and if they offer renewal next year, they'll probably stay with them again. But it's just very unstable from a standpoint of like, you don't know, you could get a cancellation at any point. Like, they just decided recently that they're not writing any Class A or anything that's not a Class A complex. So, you know, if they just offered you a quote on your Class B or Class C in Austin or Houston or DFW, you could be getting a 30-day cancellation notice in the mail. So it's just, State Farm is, I think State Farm is, we went through this in Colorado back in like 2015 with American Family, where American Family like literally wrote the state. I mean, they wrote everything, and then they non-renewed everything. And then we came in and we picked up a ton of business. And then 2020-ish rolled around, and we lost most of our business to State Farm. And so then State Farm will probably start non-renewing stuff. We'll kind of come back in. It's just it's a cycle, sort of like the housing market, like the stock market. It's peaks and valleys. And I think, you know, State Farm is sort of in that valley where they're kind of going to get off of a bunch of stuff because they haven't been profitable on it.
No, that's interesting. Yeah, because I've heard rumors at other places too that they may have, you know, overextended themselves as well. Kind of going back to some of the examples of just buying a property, right? It's, if you're buying a property now, your insurance is going to be really high. Let's say you bought the property, and I doubt this will happen, but it may, right? And then somebody sells it in a year. Will the buyer after that, will their prices increase crazy high, or is it now somewhat stable?
So in the event where like you're buying a location and then you turn around and you sell it again in a year?
Yeah, with the next buyer after that, like, will it just continuously increase by 100% through each acquisition, or at some point is there a cap for the price per square foot?
I think well, there's two different things there. So like the price per square foot, that's going to be more tied to just what the actual cost of reconstruction is. And that's obviously, carriers are seeing that. Carriers use some different valuation software like E2Value or Marshall and Swift are kind of the main valuation software that carriers use and to run their per square foot reports. But from like a pricing standpoint of things going up like 100%, it's all going to be about just, can the insurance companies find kind of that market equilibrium where they're actually making money? And it's tough to really predict that. But I think after the amount of increases in 2023 and the lack of, I mean, we did obviously have a horrific wildfire in Hawaii, which is not good. and multi-billion dollars paid out there. But from like at least a named storm perspective in, you know, in the stateside, it was a good year. So I think there's going to be, I think 2023 should overall be hopefully a closer to profitable year for insurance companies. So I think at some point, like, I do think that there will be some easing in rates. I mean, I don't think it's just an automatic that like you sell a location and it increases 100% for the buyer. It's really case by case too. And so it's tough to like speak in really broad terms with that. Right now, like you are seeing some of that in Florida. Obviously, you guys are going through it right now with one of your assets that you're looking to sell. But that's unique because that's such a good deal. But had that location, like in theory, been non-renewed by the incumbent carrier, and you got hit with a 200% increase or whatever on renewal, then that would probably carry over pretty equally to the buyer. It's just, but you were kind of grandfathered in with the carrier, so you got a good deal. But then the new buyer isn't grandfathered in, so potentially they won't get that even close to that deal. It's just it depends on a kind of a case by case. So it's tough to say, but I wouldn't expect that, like, I mean, 100% increases every year they're obviously not sustainable. I mean, and I do think we're going to start to see more defaulting, unfortunately, just between obviously anyone that's on a bridge loan, and then between interest rates rising and insurance rising. I do think it's a tougher economic environment. That's just a reality. But the other reality is like at some point, you know, back to sort of the legislation. I mean, if insurance costs keep going up 50 to 100% every year, it's people can't afford it. And so something's gonna give. Either the government will get involved, which like isn't probably ideal, honestly, because anytime the government gets involved, it's a mess in terms of filing claims and getting payouts. I mean, it's a nightmare to deal with FEMA. So it's not going to be a pleasant experience for anyone. But if that's the best alternative, if that's your only alternative to defaulting because you can't afford insurance, then that's what's going to have to happen. So I do think that I think we're going to find some equilibrium though. I'm at least hopeful that 2024, I think, will be a little more of a palatable year, you know, hopefully again, kind of back to that, maybe that 20-30% range for increases instead of 50 to 100 to 200.
I think people will just be static if they see those numbers.
Yeah.
Great. Well, Stephen, do you have any last questions for Zach?
I think this has been great, Zach. I've enjoyed this discussion, and you know, I know you and I have been talking on and off over the years as well. So thank you for that.
Thank you.
Yeah, no problem. Appreciate you guys having me on, and good discussion.
Same here. Thanks, everybody.